Hello guys, and welcome to the second lecture on volumes, where I will explain the key guiding principles to correctly use volume in your trading. I mentioned in part 1 of the course that professionals or market makers contribute to more than 60% of the daily trading volumes in the forex market. So retail traders must be able to analyze that market activity of professional traders revealed by the volumes in their trading to trade successfully. All in all, there are three key principles that you need to know when using volume. Principle number 1, it's an art, not a science. Principle number 2, validation or anomaly. Principle number 3, present volumes are not relative to past volumes. The very first thing that you need to know to understand the first principle is that learning to read charts using volumes is an art. It is not a science in any manner. Although it is very easy to enable volumes feed on your trading charts electronically, it takes a little while to become proficient at this form of technical analysis. In my trading itself, it took me more than a year to correctly figure out the best use of volumes. After all, a market never stops and reverses within a space of 1 or 2 candles. So a spike in volumes is not associated to a price reversal straight away. This is because near a price high or price low, the first warning of a price reversal appears, then market enters a congestion phase, where market pauses and then it reverses. This is where elite waves and price action become so powerful and are therefore key elements of this trading strategy. In elite wave principle, those congestion phases are reflected by the corrective waves. Therefore, be patient and wait for the reversal, as it will come, but not instantly after one candle. Let's understand the first principle using a very interesting and live example of euro dollar on a daily chart. This current price activity is within wave C of wave 4 on one larger degree, as you see here. Starting from this point where wave B terminated, you can see that buyers enjoyed a sharp price advance on this pair. Even within sub-wave 5, the third wave was an extended wave. Now to understand the principle of volumes, notice how this signal top candle associated to high volumes stopped this price advance. However, after this signal top candle, sellers ran out of fuel and price went up again. 4 days later, the second candle associated to high volume stopped the price advance yet again. Now, as an elite wave technician, you will be thinking a step ahead of other retail traders, because you know that this is where wave 3 terminates and it is the start of wave 4. This is the start of the congestion phase in the volume analysis and is linked to entire price move in minor wave 4 and 5 within sub wave 5 of this price advance. Once this congestion phase comes to an end, a major price reversal is due on euro dollar, which once again will be signaled by a strong price action pattern combined with high volumes. This market activity of professionals to build for the next big move is visible on any trading instrument. Guys, this is where you need to be carefully watching the price action to position yourself with the smart players. This is where the money is. With that being said, let's continue studying the second principle of volume-based analysis. At any given time, we are only concerned about two things while comparing price with volume: whether the price has been validated by the volume or whether it is an anomaly. If a price is validated by volume, then that confirms a continuation of the price. On the other hand, an anomaly in price and volume signals a potential change in trend. Let's understand the anomaly and validation principles using Forex examples. The first slide explains the validation of price by volumes during an uptrend and downtrend. Firstly, in an uptrend, notice how price advance is linked to increasing volumes on almost all of the candles. This therefore means that professionals are most active on the buy side of the market, which is revealed by the volumes. Similarly, in a downtrend, the market activity near a price high reveals that bearish candles as well as candles with large upper shadows are associated to high volumes, hence signaling a price reversal. Notice how market went into a small congestion phase before the price declined with increasing volumes. Now let's study how a retail trader can figure out price anomaly in a market. Firstly, in an uptrend, notice how price increased on a decreasing volumes. This typically means that professionals are exiting their buy positions as a reversal is due in the market or simply because market is reaching a significant price high. Similarly, in a downtrend, fall in price associated to decreasing volumes comes with a warning that a bullish reversal might be due. In both of these examples, what we see is anomaly where price is not validated by the volumes. Guys, please visit different charts on your trading platforms to understand this second principle in your free time. More you practice, easier it will become to understand whether the volume are validating a price or is it an anomaly. And finally, the third principle that you need to understand says that while using volumes in your trading, the present spikes in volumes are not related to past spikes in volumes over any given time frame or any trading instrument. Therefore, all we are concerned about are the few recent spikes in volumes as we analyze the current price action. And it becomes irrelevant how large or small volume spikes were in the past compared to the present ones. Let's understand the third principle using an example of New Zealand dollar and US dollar on a daily chart. I want you to focus entirely on the selected volumes here on this chart. Notice the difference in daily volume spikes highlighted in the boxes. So the principle number 3 explains that, let's say you were expecting a price reversal here on this point in the chart. Then it becomes irrelevant to how large or small the volume spikes were in the past. All we are concerned about is the recent volume spikes or activity or last few sessions as I show you here. This principle stays true to any time frame or any trading instrument that you wish to trade. Guys, this is all you need to know about the key guiding principles of volumes, and this also concludes this lecture, and I will see you in the next lecture.